Good morning, everybody. This is Dennis Wood with the Active Trend Traders. Welcome to the How to Make Money Trading Stocks weekly free webinar we do every Friday at 11 a.m. Pacific time. It's about 9 o'clock in the morning over here in Hawaii. Mike and Michael are not joining us today. Michael is having a family get-together, and Mike's playing tennis. So when he does get online in the future, give him a hard time about playing tennis. He's got to have his priorities straight. But every week I am here. Looking forward to moving forward into next week. Have been doing a lot of back testing, a lot of refinements and this type of stuff moving forward. I'm really liking where we are sitting going into the end of the year in preparation for 2017. I want to remind everybody that all the materials that we do present are for training purposes only. Traders should always paper trade any new method prior to the risk of their own personal capital. Here's Michael's disclaimer if he was with us. So I recognize there's a lot of new folks who are joining us every week, and I just want to slip this one slide in that kind of gives a little bit of background about who I am, where I've been, what I've done, how I work with Mike. He's my research partner and colleague down in Dallas, Texas. We got together, oh gosh, about 7, 8 years ago, and just over coffee, and then all of a sudden we found our interests lay in the same area, and so we go together and make a really good team. Mike is very big on the history of the stock market, and also he pulls out little golden nuggets. Those of you who've read his articles about what has happened in the past in the market and how we can take the clues to look what's going on currently. I'm the technical analyst guy. I basically utilize the ETFs, the index ETFs, and growth stocks that meet IBD criteria. I am not a pure canned slim kind of guy, but I just, I'm a technical guy. I do not like doing fundamental analysis, so I basically use the fundamental analysis that IBD does, and if a stock meets their criteria, then I will entertain bringing that onto our watch list. And so anyway, I just wanted to share a little bit about where I've been and what I have been doing. One of the big things that Active Trend Traders that I always emphasize, I think training is so important, and in the emails that I get from many of the members of the premium members of the Active Trend Trading system and the early warning alert systems, is that the emails I get where they're showing that they're taking what is being presented and taught on Wednesday nights primarily, and then applying that to their trading. And I just love to hear how they've taken it, made slight, some modifications or whatever, and then are turning that into being successful and very, knowledgeable, wise, disciplined, and profitable traders. So training is very important to me. Next week, we're going to be covering on December 7th, we're going to be covering 5 objective profit exits. And one of the things that it's very easy to get into a trade per se. But oftentimes what is missing from the equation is a person having a game plan for how to get out of the trade, and that includes both a stop loss, that also includes profit targets, and this training is going to provide some really good background about how to stick with a trade to let it run as far as possible so that you can basically wring as much profit out of the trade as possible. So we're looking forward to getting that done. So let's get into the market update. The market is currently taking a breather. How much of a pullback? One of the things we always have to consider is when a market runs, when it goes fast up, oftentimes it follows with a fast down. So on the individual tracking indexes that we track, the S&P, the NASDAQ 100, and the Russell, the S&P is in a pullback mode. How far will it go in that mode is yet to be seen. The NASDAQ 100 and also the NASDAQ Composite both went into a harder fall and are falling back to lower levels of support. And we have to remember that the NASDAQ did not participate as much in the Trump rally as the NASDAQ Composite did. The NASDAQ Composite did break out and hit new highs. So it appears from the charts that the NASDAQ and also the NASDAQ Composite may actually be in a stronger pullback, and that's currently underway. The two big, dark bearish candles that we've seen on the NASDAQ over the last 2 days are showing that sellers are definitely winning the battle when it comes to the tech-heavy NASDAQ. The Russell in pullback mode, and different than the S&P. Currently, the Russell is holding its breakout support where it broke to the new high. Right now, or at least when I put these slides together, it was holding that and not dropping below that. What are some of the outstanding things that are going to potentially influence the market going forward? Well, the one big one that we have coming up on December 14th is the Fed meeting. The probability and expectation of an interest rate in December is very high. It would be kind of a surprise if the Feds didn't raise rates. The question that we all kind of come up with is, over the next few weeks, next 2 weeks or so, will the market sell off in anticipation of the rate increase, or will it maintain where it's at? Remember, we recall back to December of last year when the Feds raised their rates after having left the rates very flat for, several years. The initial response of the market was very negative, and it led to what appeared to what was going to be a really significant sell-off, and perhaps even going into a bear market mode. But that didn't take place. Global markets. Michael over in he's in Switzerland. It basically was saying that one of the things, Italy is having a referendum similar to Brexit, but he says that they anticipate that Italians will not vote to exit out of the EU. What type of impact that's going to have, within the European market is unknown at this time. Wouldn't it be interesting if it was a total surprise and they also voted to leave the EU? That could lead to some, well, not as poignant as the Brexit, but it may shake the markets a little bit. And then going into the end of the year, we're gonna have a, have we already had the Santa Claus rally? Perhaps. Some people, the Santa Claus Donald Trump rally, perhaps, or are we going to get, with a bad reaction to the Fed, a lump of coal in our trading stockings moving into the end of the year? We shall see. So here's one of the indicators that Mike and I use primarily to pick bottoms in the markets, and it's done a very good job this year of picking markets. Here was last week, and as you can see, we were making new highs, getting back up above the 80 level. That means that 80% of the stocks in the NYSE were above their 20-day moving average. And as you can see, we've had a really corrective action this week, moving it back down to just above the 60% level. And just as a reminder, when this, Mike and I primarily focus when the index gets down here. This is one of our early indications that, hey, a reversal could be happening. And then we depend on some other proprietary information to be able to then program ourselves into trade. Those of you who are early warning alert members, I hope you got the email I sent out last night about what the refinements that Mike and I are doing. We're looking forward to what's going to be transpiring in 2017 with the early warning alerts. One of the things that was a challenge this year with it is that we had, we'd get the signal, but then there'd be no secondary entry trigger because the move would be straight up off the bottom. And we've gone back and retaken a look, and that didn't happen very often, even in the 13 years of back testing and the previous 2 years that we've been running the service. And what we have been able to pull together is an added proprietary indicator that basically will enable us to take advantage, even when on these, straight up off the bottom moves, to enter trades, and we're in the process. The initial back testing that looks really good, and so we're looking forward to utilizing that moving forward, because it looks like it's working through all market conditions. So as we say, right now, no news here, because we're waiting for, hey, what's going to happen when it gets down here. Projecting down. If it holds at kind of like the same trajectory that it's moving at right now, that could put us down toward below the 30 level towards the middle of December, which just happens to coincide with, guess what, the Fed meeting. So we'll see what transpires from there. But yeah, Mike and I are really excited about the slight refinement that we're making to the system. So here's where we sit. Market has pulled back a little bit from last week, but the Dow is still up 10%. And this was as of 9 o'clock this morning. S&P still up for the year. The Russell had gotten up as high as 18% for the year, and it too has, sold back off a little bit. All of the indexes that are being tracked here are currently still above their high from last year. So that's still working as a support level from that breakout. Let's take a look at some charts. There we go. And here is the S&P. I've redrawn and put in the new Fibonacci retracement going from the swing low on November 4th up to the swing high that actually was hit on 11/30. And then after we hit that high on 11/30, which was Wednesday of this week, the market is kind of sold off specifically. Of interest is that this level at the 2193 level, which was what I call breakout support, it hardly held on this pullback of the S&P. And so we were sitting there, we're pulling back, where's the next potential target? It closed below the 8-day, but the 8-day had rocketed up with the price action. So somewhere in between the 2183, which is a 23.6 retracement, and the 20-day moving average is where the most likely level of next support is. As we can see, the TSI has rolled over, and I encouraged everybody on Wednesday night to go back, and I hope some of the folks who are premium members did do this. Go back and look at, look several years worth of data to see what happened with the price action when the TSI crossed below the 50 level, above the 50 level, then back down below the plus 50 level. What did the price action look like from that point going on? Daily wise, the momentum is still moving down. We know that the zero line on both of these oscillators can act as a level of support, and so if the current trajectory remains what it is right now, we can expect the momentum to hit that zero baseline around the 5th, which I believe is next Monday, and so we'll see what transpires from there. let me get rid of the fibs so we can take a look at the, there we go, get a better look at the weekly chart. So I'm going to blow this up a little bit. And as we can see here, if prices close where they are and don't drop anymore prior to the end of the day, then we will have a significant bearish harami in place. Matter of fact, a bearish harami that is so big that it's almost a bearish engulfing. Not quite, but almost. And so that would be definitely significant, because while it was doing that, we are putting in lower highs on both the momentum and the true strength index. While the market had been making new highs, that is definitely negative divergence on a weekly chart, and could it could be a forewarning that more downside is in the offing. Will it drop straight down, from where it's at right now? I would like to say no. However, this year has been really an interesting year, because we had several almost straight down drops, followed by immediately straight up moves. And so the moves this, if you isolated this weekly chart, you'd see like you'd get 2, 3, 4 weeks of hard down, and then 2, 3, 4 weeks of hard up, and followed on by just kind of a little bit of sideways move. And that has happened in almost every move that we've had this year. Bob asked a question. There seems to be so much conventional wisdom when it comes to market parlance. Do you not get caught up in it when it comes to terminology such as overbought, oversold, needs a rest, etc.? How does one get around this conventional thinking? Well, Bob, those are just basically regular terms that are utilized within the market, and also technical analysis. When I use those terms, I'm basically looking at what are the oscillators telling me? How far am I away from moving averages? When you get extended away from a moving average like the 20 or even the 50, that's a definition of being overbought to the upside. Or on the flip side of that, when it drops down below the Keltners and is extended away from the moving averages, the mean average, it's outside, a standard or 2 standard deviations, and can be considered, and you get these plunges in things like the true strength index below its negative 50 level, and you get a spike down in the momentum. That rolls into the definition of being oversold. And I mean, that's just, straight technical analysis assessment of what's going on. I don't listen, I don't watch the business channels whatsoever, so I read a little bit, but normally my assessments are basically, when Mike and I make an assessment, it isn't from what we've read or what we've seen, it's from what we see on the charts. Hope that answered your question. Let's take a look at NASDAQ. Well, first, let's go ahead and take a look at the NASDAQ. Boom, boom, boom. There we go. Okay, as you can see, this is what I was talking about with the NASDAQ, where it did finally, here's November 3rd. We get a relief rally, push back up, but unlike the other indexes, the NASDAQ flipped back around and did a big major sell-off after the election, but then kind of got its traction about mid-month of November, and then flew back up. However, when it got up into this resistance zone made by these lows and these highs, it started slowing down. So this is Wednesday. This is Tuesday. Here's Wednesday, and we can see a huge bearish engulfing pattern on a daily chart that engulfed 1, 2, 3, 4, almost 4. 1, 2, 3, 4, 5 previous price moves. Normally when you get that kind of sell-off, it's very significant for changing the character or posture of the rest of the market. So as you see right now, we have now dropped down below the 100-day, I think that's the 100-day, yeah it is, the 100-day moving average. And if we took a move from, let's take this move from here up to here, we can count that as one move. What is it telling us on the fibs? Well, as you can see, look at that. The fib has dropped outside the 61.8 retracement, and normally when that happens, if one of these things are violated with a close below it, it basically is an indication that the path of least resistance is at least down to the next level on the fib. So that's taken that one. Let's move back, move that. Oh, let's remove that. And we can also do another fib from here to here. As you see, it's sitting right there on this most recent move, sitting just above the 786 retracement. So very interesting. How would I, look to potentially trade the NASDAQ or the Qs in this case? Well, it is pushing its way down. It would not be surprising to see it bounce back up. It did this morning. Where did it, and normally when they bounce like this, and I talked about that a little bit on Wednesday, where do they usually bounce to? They usually bounce to the middle half, or middle third, if you will, of the previous large candle. And that's exactly what happened today. Corresponded to resistance at the 100-day moving average, and then after a quick move up, it has then fallen back down. Like the S&P, you've had a crossover there, a divergence and a drop here. Note that both of the TSI and the momentum on a daily chart are below the zero line. Normally an indication that we're going into a more prolonged meltdown or turnover. Same thing over here. We had definitely negative divergence. I don't want that. I want something else. We basically, this downtrend line on the TSI and also now this downtrend on the weekly momentum is telling us that, price action and momentum that would be normally there to prop up the stock or the index is basically draining or dripping out, or in this case with the big moves, it may be a gushing out of this particular index. So the way you can basically, and so if the 100-day, if the zero line on the weekly breaks, as it did earlier this year, at the beginning of this year, that's when it increases the probability that the pullback is going to be even more severe. And so Bob asked, why does the TSI show a double line? That's because it's measuring both. It has a slow line and a fast line, and you should have that same indicator, Bob, because I know I've sent them to you. So that's that. Let's take a look at the Russell real quick. RUT. As you can see, Russell, and this is what I was talking about, is Russell is actually, okay, I'll give you the positives first. The Russell is held above its breakout level and is, a good ways away from it. The negatives, and so that may work as a strong level of support moving forward. Let's see where that works out on the Fibonacci retracement. As you can see, this 1302 down to the 1298 level is a nice little area of a support zone that I would be looking at for, you know, potential pullback down into there, especially as long as normally the TSI on a daily basis got up to above, you know, above 80. And we're getting a rollover, and normally when that kind of rollover, when this is so overbought happens, the pullback can be, you know, I hate to use the word significant, but it can be more than you anticipate. If you go back to the Dow theory, you know, Dow would say after a move up, oftentimes you get a pullback of 1/3 to 2/3. Well, that happens to coincide down here with the magic fib box from 38.2 to 618 retracement. And that's what's considered actually a normal and a healthy pullback. And so we'll see if the Russell does in fact pull back into that area. We have broken below the 50, or correction, the 8, and it looks like, you know, there is support right there at the 20, and it just happens to correspond with the breakout support at the 1295 level. There we go. And I'm going to drop this for a second, go over here and look at the, so that was kind of the, you know, the good news is it's holding this level. Some of the bleaker news, if you will, is that this is a fairly significant bearish engulfing on a weekly basis chart. And normally when you get a sell-off of this significance, that it does a couple of things for us. One, it definitely identifies where there is strong resistance, which is up at the 1247 level. It is still very extended away from the 8-week moving average and the 20-week moving average, and so it has a way to fall until it finds support at one of those moving averages, and then for a potential rebound from there. And you know, how long is it going to take for it to get there? Again, the you know, it could be several weeks. Things typically don't go straight up or straight down, and so that's what we'd be looking at. The way I'll be looking to potentially assess the assess the Russell next week is I'm basically going to take about the midsection of this large candle, which is right there about, you know, 1325, and if the market is going to come under more heavy influence of sellers, what tends to happen, like we saw happen this morning, is you get an initial push up in the market, or even sometimes a slight gap up into the previous, you know, bear candle, and then the sell-off resumes and pushes back down. And so I'll be interested, you know, next week, if prices push back above the 1325 level on the Russell and then start to show weakness, that's when I'm going to be interested in looking at a position in TZA, the 3x inverse ETF for the Russell. So that's the way I'll be, you know, looking to trade that next week. So any other questions on the indexes? As you can see here, negative divergence going on the two indicators, and we want to pay attention to the weekly chart here, because the weekly charts can oftentimes give us the heads up that things are going either up fairly significantly or to the downside fairly significantly. Okay. I hope you found the assessment of the indexes valuable. And what I'll be using to trade off of any of the three indexes is I'll be either using the 3x the 3x non-inverse or the 3 times inverse ETFs that emulate the 3 indexes. Keep a look at my time here. We're doing good. So path of least resistance. At least for the interim, I'm looking at the path of least resistance being down. Now, Mike, I have to share this with you, Mike Traeger, he basically has a very bleak outlook of the market going into 2017, and so which he has shared numerous times on the with the members, you know, and or on the webinars on Friday. But I think that basically we still have a little bit more downside. What we may see, since we've had prices roll over and the moving averages are now dropping, we may see pull-ups into the moving averages and then a drop from there. And so in the short term, we have to look at each one of the indexes did reset into an uptrend because it took out the, you know, series of lower, higher lows, and finally broke out the top, made a higher high, and we'll see if it retraces. You know, so we're going to see how much of it retraces. So we have to treat it like, we have to treat it with caution that it is in an uptrend, but anytime real sharp moves, either up or down, happen, the follow-on is always suspect, the follow-on move. Okay. So here's where we're sitting. This week we had dropped a little bit at the end of November. November was a challenging month for us. But this week we pulled in from strategy, some for strategy 1 and from strategy 3. And as you say, I always like to, you know, put the equity curve of closed trades onto the every week. I show this. I'm not, you know, I share it with everybody saying, hey, here's what happened, because as I've done in a lot of my coaching and some of our training sessions, you have to remember, and this is one of the biggest things when I started trading for a living, is helping my wife understand that when you trade for a living, it is not like a 9-to-5 job where you go from Monday to Friday and every 2 weeks you pick up a standard, you know, regular paycheck. This is more like a sales position, and sometimes you make your quota, sometimes you don't, and sometimes, you know, you have drawdowns, and some, you know, but you want to basically, as long as we're pointing up and to the right over the long term, we're good with that. And so here's where we're sitting as strategy 1, strategy 2, strategy 3, cumulative for the year. The November drawdown accounted for a 1, because I get this question all the time, what's your, you know, what's your biggest drawdown for the year or for, you know, any particular trade? And so in November we did have a 1.25% drawdown. So future presentations. We're going to have 2 webinars in January for the Bay Area Moneymakers to get us closing out 2016 and preparing us to move into 2017. I will be presenting to, and I see, yeah, Doug's on the line. And you know, Doug, I never got the exact name of your group, but so I just called you the Atlanta Technical Traders. We're going to be presenting to them on December 8th in the evening time. They're in Atlanta. This Wednesday, we're going to be doing our standard premium training session at 6:30, 5 objective profit targets, and then new videos for premium members. We've already done some how-to strategies, timing entries, and Mike and I are working on a video that's going to base. Oh, okay, thanks, Doug. refinements that we have made to the early warning alert service, and then prepping for a year of accelerated or explosive growth in 2017. I'm really pleased with the addition of the leveraged ETFs into our watch list for premium members. And this morning I was sitting there just, kind of doing my quiet time, and this word just kept coming to me: accelerated growth, accelerated growth. And so I'm looking forward to what's going to be taking place, moving into finishing off 2016, because I would like to bring that equity line closer to the 40% that is our target for the year, and we'll see what transpires from that. So here's one of the trades that we did after adding the leverage, some of the leveraged ETFs into our standard watch list. Is the trade we did earlier this week on SQQ. And we're a little bit cautious, but we entered the trade here on 11/28. We bought in at $13.19, and we hit T1. We had a T1 place between 5 and 10%, so we took off part of the position at 7%, and we're holding the remaining portion of the position, either break even or for it to hit somewhere between 15 and 20%. That 15 to 20% is up here in the 1480 to, back to its previous highs here. If the market does, oh great, David says he sold 50% of his for 7.5%. Excellent. If the market moves into a similar type of situation after the Fed meeting as we had last year, SQQ could push on up. I'll be looking to add to this current position on pullbacks back to where? Back to the 820 combo, and then with reversal signals off of that. And that's where, and those of you who are premium members who go for the final hour presentation right after this, I've got something to share with you today that you're going to go, whoa, that's going to improve your ability to basically trade that strategy 3 on your own. And so I'm really looking forward to sharing that with you at that time. So with the active trend trader, I focus on the 5 pillars of active trend trading. Is basically pillar 1 is we want to know what to trade. And I focus on top quality IBD growth stocks and ETFs. I need to change that word right there, because now it is, several different, a select stable of ETFs that demonstrate great technical signals to be on the move, and that's what we're waiting for. So we focus on when to enter. We provide the entry action point that I'm moving on, when to exit, what profit targets, what our stop losses is to control our downside. That's our insurance policy. What strategy we're going to be using, either 1, 2, or 3, and what to expect. One of the things that, and there's this, I listened to a guy the other day, and he said that strategy is more important than systems, because systems are what, systems can be too binding, so you need to be totally flexible. And I totally disagree with that, because I've seen too many traders who they'll get hooked into a strategy, but they have no strong foundation. Our strong foundation is the active trend trading system. Then on top of that, then once we're solid on the system, then the system, we basically trade the system for each one of the strategies, because the system is what tells us where our stops are, where our profits are, and if you're just trading, if you say, hey, my strategy is to trade stocks and index ETFs, well, that's all well and good, but what are you going to do? Just shoot from the hip and say, oh, this looks good, let's do this? Nah, your system is what, knits all of this together. So this is something I don't normally do. Those of you who've been with us for quite a while, I don't normally talk about, or invite people into membership with the active trend traders. I leave it on the website. Like most of you know, I'm a former civil engineer. And for those of you who know civil engineers, there is no such thing as a civil engineer of any type. I can say that because I am one. But anyway, just to get back on point is through the end of the year, I want to basically provide folks who tune to this webinar the opportunity to become either a premium member or even take a look at the early warning alerts, 40% off the regular monthly membership. And with this regular monthly membership, you get about $350 to $400 worth of just, webinars on Wednesday nights and training sessions. Excuse me. And then also the early warning alerts. And so if you are interested, give it a try. If it's not your cup of tea after a month, you can just drop it. There's no obligations. But here is the website where that can be found, or the page. And so, as I said, I am not a big marketer. I want to do my technical analysis, and that's it. So yeah, you electrical engineer guys, David. I mean, I could go on, but I won't. Anyway, so that's it for the day. I want to see how I'm sitting. Yeah, we finished up just a little bit earlier. It's probably because I'm by myself and Michael is not with us, but we will see you next week. Keep growing the egg. Very, very important. And I've included here, trade wisely, trade profitably. And here is, if you want to contact me on Twitter, there's the link. And so if you are a premium member, stand by. In about 15 minutes, we'll be starting the final hour. And we will press from there. Now, we are finishing up just a little bit early, so I have time to look at a couple of stocks that you guys might want to look at. So let me answer the questions that are here. Is Doug, when will this be posted? It will be posted, and an email will be sent out to everybody who registered for this webinar. It will be sent out probably early this afternoon. This one's a fairly quick turnaround because there's not, a lot of editing or anything to be done to the the video. Okay. The bold timers. Let me write that down. Thank you. So, yeah, Bob Bowden. Yeah, that's basically it. I mean, I don't know if the system creates the strategies, or because those strategies are just are out there, and a lot of people try to practice a strategy without having the system. So, David, I agree about electrical engineers. Linda, you're welcome. And Gina wants to look at XOP. And I want to voice a real quick appreciation to Eric if he's still online. Eric, thanks for sending me that email that covered those two 3-time leverage biotech ETFs. That's excellent. XOP. Okay. The oils. And so XOP, is rallying with oil. I mean, it's basically taken off here. It has made a nice big run. It spiked up with the supposedly the news from OPEC that they're going to regulate their output more to try to drive up the price of oil. I'd be looking. Let's see who asked this question. Gino. At this point, yeah, it's extended, but it is definitely back into an uptrend, which is very good. It has broken past this level of support here, so you've got breakout support at 40.95. I would be, if you like this one, that's great. You can also look at the leveraged versions of this, which would give you, if I were, and here's something. If I were trading options, I would probably look at trading this. However, I might want to take a look at, I think it's UCO, which is the the bullish for crude oil, because it moves, from its low, it moved up, and again, this is just taking advantage of the leverage, and as long as you are trading a plan where you've got your stops and all that kind of stuff, you can do that. But it moved, well, 31 points or 31%, while XOP moved from here to there. Actually it moved pretty good. It moved 23 points up to 23% up to its high. So, and it's got really, as you see down here, lots of great volume, and so, and it probably also has weekly options, and so you may have more flexibility trading that. I would wait, of course, for, this is not a buy up here. It needs to do some consolidating and pulling back into the moving averages, and or letting the moving averages catch up with that. If it just drives sideways here, that would be okay also. But yeah, you've got secondary support down here at the other breakout at about 39.56. So any other stocks we want to look at, guys? I will also put out that if you are if you are not an active trend trading member, you can join us for either the the free weekly newsletter, and sometimes the market updates are included in that. There's a free market update for something that I don't go into the individual orders and positions that we're trading. But one thing we are doing differently this year is I want to, or through the end of this year and into 2017, I'm going to put out one trade per month that's going to be open to everybody, and it could be a trade in Nugget, it could be a trade, but you need to be on the early active trend trading, at least the free newsletter mailing list. So, okay, GasX. As you can see here on GasX is bearish on probably nat gas. Yep, natural gas. I would be, watching this. Was that from you, Eric? The seasonality in natural gas is typically to run up a little bit into the first of the year, or after the first of the year. So let's take a look at where it was last year at this time. And as you can see, and it's primarily due to the winter months on the East Coast. And I know that a lot of times people may have their contracts for gas that they get during the summertime, but there tends to be a run-up of the value from December into late January, sometimes that can extend into February, and then it falls off. So are we setting up for something similar here? And as you can see on the weekly charts, this doesn't tell us a lot. I mean, even if you start breaking it down, and part of that is because of the backwardation. That's an issue with inverse ETFs and what they have to sell, the type of entities that the obligations they have to sell in order to get into a bearish ETF. But short term, I mean, we may, it may be setting up down here for a run higher. As I said, weekly charts kind of useless in this particular entity, and part of it also is because it's only been around since November of last year. At least that's where the data comes from. But so, are you looking upside or downside on this, Eric? Okay, just buy. So, what I was looking at is if this is the bearish, it is bearish. Then my question is, so prices of nat gas are going up. Normally nat gas does go up at the beginning of the year, but in this case, last year, nat gas prices went down because this went up. So that seems like an anomaly that I'd be looking at. I'd go and find the ETF just for nat gas and take a look at that moving forward. So, okay. Yeah, reversion to the mean could work for you. But again, it looks like the majority of information you're going to be able to get off of this is going to be off the daily chart and probably the hourly chart, but not so much on the weekly chart because of these huge swings. And just the data isn't nice and smooth. So with that, guys, I'm going to call it a day. I want everybody to have a wonderful weekend. Enjoy some football, some college football, pro football. And so I'm going to say adieu and God bless everybody. Have a great weekend. Bye-bye.